Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for July 18th of 2022. Please see our disclaimer for important information. In our high frequency data here this week, we can see a little bit of erosion in some of the key metrics that we've been following rather closely that have actually held up pretty well. Hotel occupancy is down a little bit. Supply of motor gasoline down notably. I think that's probably the clearest sign of some demand destruction with high prices, even though we've seen gasoline prices come down about 25 straight days now. But nevertheless, we do see a little demand destruction there. Open table over the month is still strong, but over the last week was still a little bit weak. And when you look at the more industrial things, railcar traffic, steel production, both down for the week and the month, and we've seen particular erosion in railcar traffic as we see goods demand begin to weaken up here a little bit. Labor market remains fairly strong, but we are seeing a little bit of an uptick in jobless claims. That's actually to be expected. But otherwise, we see in TSA checkpoint data some reasonably strong data. So despite inflation, despite some of the other constraints perhaps on spending, we do see a continued interest for travel and leisure. And some of that has to do with a rebound from the weak environment that we saw even just a year ago. I thought I'd show this slide here from Charles Schwab. This is a kind of a synopsis of the leading economic indicators. And so you can see here there's leading economic indicators and there's coincident indicators. And this is a real good summary of each of those and what goes into it. So when you think about what's strong and what the trend is, this gives a terrific summary of that. So where we still see some strength, obviously building permits, particularly on the residential side, we know that there's a demand supply imbalance. Prices are still high, although we do see some moderation in home prices here. But building permits remaining really strong, and then the labor market, of course, remains very strong. Average work week, the Institute for Supply Management New Orders Index, we do see that kind of flagging a bit. New orders for both consumer as well as non-defense capital goods. We do see that, and obviously the S&P 500 has been treading water with lots of volatility here. So, and consumer expectations, we have seen those indicators be fairly weak. But what we see in the trend, at least for leading indicators, obviously unemployment claims, we just mentioned that that's beginning to trend a little bit higher. New orders index, we may be on the verge of a manufacturing recession, which coming off of the tremendously strong environment we had during the COVID year, 2020, is actually a reversal of some of these amazing trends that we saw then. But in the case of looking at high inflation, obviously goods demand, those are higher ticket items or tend to weaken up in that environment. We do see that in fact happening here. But building permits, again, the housing market beginning to level off here with high rates. It's kind of killing some demand. We see that in new mortgage applications. So the housing side of it, I'd say worsening is a pretty strong label, but I'd say moderating is a much better one. Obviously the S&P 500, and then interest rate spreads. We know what's going on there. Leading credit index, actually not that bad. Now, when you look at coincident indicators, this is like the data that it kind of gives you a sense of where you are right now, as opposed to leading, which is kind of gives you a sense of where you're going. But when you look at that, there really isn't anything that gives you a whole lot of concern right now. Payrolls, personal income, we know personal income is really strong. And for those who think that we might be in a recession, and we'll find out here very soon on the second quarter first reading of the economic growth number, the GDP number, whether we are in fact negative for the 3 months ended June 30. But it's very odd to see a recession when you have personal income this high. Industrial production remains relatively strong. And then real manufacturing, despite the drop in demand, remains relatively strong. Here's a quick look at retail sales. You see in the light blue up top, that's a nominal rate. Obviously, it's a number that looks very good. If you assume 7.7 year over year is a good number, and I think it is. You can see the trend line there and how we've recovered from the pandemic. Now, if you inflation adjust that and get to real retail sales, which is what's down below, in this chart from Charlie Bolello, you can see that we're actually down year over year. And that, again, that's the impact of inflation and where that retail sale, where those sales are going, increasingly in gasoline and food. Here's household sentiment. That number continues to flag, and again, it's a number that just didn't change overnight. I mean, that number has been slumping for a little bit of a while, and really it's coming off of a peak, and we obviously had a very weak environment, pandemic, we had the recovery, and now it's flagging and rolling over. And both the consumer sentiment number, which is the University of Michigan, which is much more heavily influenced by inflation. So notably, you can see how weak that is. And then the Conference Board consumer confidence number is also weak, but not at the troughs that we saw at the depths of the pandemic. On the right side, you see consumption, which is real personal consumption expenditures on a percentage basis month over month. Those are those black bars, and then the quarter over quarter real PCE numbers on a seasonally adjusted annual basis. There you see in the orange, and you can see how they're trending slightly lower as well. Well, obviously the big news was inflation, and it was 9.1%. This is actually from a tweet kind of summarizing this from Liz Ann Saunders at Schwab, but obviously 9.1% was higher than expected. Core inflation was 5.9%, which is also higher than expected, although a little bit lower than we saw in core prices, at least core price growth over the last month. And so, the key thing is headline inflation, which again includes food and energy, and we know those are higher, even though energy is beginning to moderate. Food clearly is not, though, right now, but running a little bit hotter than expectations, and obviously the market was a little unnerved by that. So we'll continue to watch this trend, and we get this data monthly. It's very important to the sentiment and kind of the health of the investment mindset right now, the investment psyche, as we kind of transition from this, in a rather stark way over the last 30 days, literally from this period of fear of high inflation to the transition of high inflation to slower growth and recession. Here's the Economic Cycle Research Institute, ECRI, a weekly leading index growth rate, and it continues to trend down. Again, this is very consistent with some of the other, what I'll call the leading economic indicator, which comes from a different group, but very consistent. Here's money supply and inflation, and really the key takeaway here, and I've got several slides on money supply because it's really important here because money supply tends to lead inflation by about 9 to 12 months. You can see this trend line, you can see the actual data over time, and this goes back a long time, but you see the upward trajectory. You can see where we are in the upper right hand corner, just beginning to roll over. Now, it's actually significant that we are rolling over in money supply, but I think you can see here clearly from 2020 how big that jump actually was in aggregate terms. Certainly nothing that we saw back in World War II, or even some of the intervening years between the World War II and 1980. We had some big years there, but this last year and a half was 2 years actually, was exceptionally strong in terms of money supply growth. So it's really healthy now to see this rolling over. Here's the M2 money supply year-over-year change. The year-over-year change is now at 6.5%. You can see the long-term average is about 6.5% with some variation over this. And this data series goes back to 1960. You can see the tremendous amount of liquidity injection around the pandemic, which was not only non-sustainable, but it was highly inflationary. And this, you see that spike over on the right-hand side, that is the epitome of the of what is causing this inflation right now. Well, here's a 3-month M2 number, and I think it's important to show you these things in sequence here. So year over year, 6%. 3-month number is actually negative. So we're seeing kind of a liquidity contraction, which obviously is happening because the Fed is removing that liquidity. We don't have that money supply growth. And again, like I said, money supply leads inflation by about 9 to 12 months. And so if you're of the mindset now, if we have this liquidity contraction that's ongoing now, and frankly will probably accelerate to some extent, then the inflation fears should temper. Now, I think this week's broadcast is probably a case study in contrasting data points, and we'll see later where some of the inflation may not be transitory, some of it's rolling over. There's still some confusion on that, but money supply is clearly coming down relative to where we were on a long-term trend line. That was the first chart. Second chart was a year over year, now back to trend line, and the near-term number, the 3-month number, is actually negative, and we expect that to continue and eventually lead us out of the inflation waters that we're in now. And we'll look at cumulative central bank balance sheets. And so this is a sum total, not only of the Federal Reserve, but the ECB, Bank of Japan, etc. You can see this a massive amount of global liquidity injection around the pandemic. And you see the huge, enormous spike in monthly changes in terms of the size of the balance sheet. The pandemic came at a point where a lot of these central banks were actually beginning to contract liquidity, and so you see that big blowout there, and now the corresponding rolling over. And I think it's important to note that inflation is not a U.S. phenomenon. It's absolutely a global phenomenon, and I think you can see the impetus for that in this chart. Here's the OECD leading indicators. Again, this is a global view. You can see the US, Europe, China against the long-term average. And you can see that not only is inflation a global issue, but also the slowdown here too. So we do see a slowdown in activity in leading indicators, not only in the US, but in a lot of areas. China certainly included in that, particularly so because of the lockdowns related to COVID. On the right-hand side, a chart from Merrill Lynch, Bank of America, you can see that global trade is falling over. And you can see that in the number that we're going to show you next, which is the Baltic Dry Index. But clearly trade is contracting on a global scale. Some of that has to do with deglobalization, right, and protecting your supply chains and onshoring more manufacturing, but that doesn't happen overnight. You can see from 2010, this number quit going up. So at a time when China joined the World Trade Organization, a lot of folks offshored to China, cheaper labor. Well, that's clearly stopped now with the threat geopolitically that China poses. And so to see this number kind of flag over the last decade and actually begin to roll over is something that a trend that I probably would expect to see persist for some time. Well, here is the Baltic Index, and you can see that freight rates are rolling over in a meaningful way. A lot of this has to do with just raw goods demand dropping. It pertains also to some extent right now to maybe the onshoring phenomenon. But again, like I said in the last slide, it's going to take a while to do that. And just as you hear of the of the domestic political battle over providing subsidies for semiconductor manufacturing here in the U.S. As a way to help incentivize Intel to build their chip plant in Ohio. You see a lot of rhetoric there, but not a whole lot of action. So I think it just underscores the fact that onshoring is going to be, I think, a decade-long phenomenon. You'll see these little pockets of announcements, but this is more of a near-term indicator. And I think what it tells you is that clearly the global trade is coming in somewhat because these rates are going down, and but they're still much higher than they were really before the pandemic. And I think that's the key point, is that inflation, there are elements of this that where freight is just simply going to be more expensive than it was before the pandemic. Here's the TIPS break even, both on a 10-year and a 5-year break even. And this is a fairly short time series. This just goes back a year. And you can see here, as it pertains to real rates actually increasing. You see both, around March, we saw the peak in these break-even inflation numbers, and they've been coming down ever since, and actually down to levels that we haven't seen since last summer, to be honest with you. And this is symptomatic of the expectation of a slowing growth environment, increasing recessionary fears. You see on the right-hand side, we've got the 2 to 10-year Treasury spread, which is now negative. It's actually been negative for several sessions now, which is the first time that we've seen that in several years. And this has some pretty decent predictive power to it in terms of predicting recessions. And I don't think it's any surprise to anybody that that a recession looms somewhere off in the distance. It's a question of how deep is it going to be and when does it actually start, assuming that it hadn't already started now. But you clearly see that 2 to 10 year is negative, and every once in a while you'll get a false negative where you get the spread that goes negative, meaning that 2-year yields are higher than 10-year yields, which is relatively abnormal when you have a growth environment. But every once in a while, that 2 to 10 year will go negative, and you won't have a recession, but generally you do. Here's the latest data from the NFIB, National Federation of Independent Business, Small Business Optimism Index, which actually had been reasonably high coming out of the pandemic. You can see the longer term trend kind of going back over the last decade. That number is really low. We haven't seen numbers this low in quite some time. On the right hand side, I thought it was an interesting post. I can't exactly remember where I found it, but just did the number of mentions in financial news of the word recession. You can see that really beginning to tick up, and obviously you saw it in the pandemic. We haven't reached quite those levels, but it's certainly picked up quite a bit. So optimism down, the feeling kind of settling in, this complacency of, or maybe complacency may not be the right word for it, but the resolution that we are heading towards a recession seems to be fairly well entrenched in the small business community now. Here is the chart on expectations overlaid with this inversion that we just saw in the 2 to 10 year. That's in the orange, and that's on the right-hand chart, and it's inverted. So we are negative now, and so when you see this chart, this data series hit its high points, again, it's inverted. So the high points here on the orange line represent points where the 2 to 10 year is at its lowest point, and in case in the case of late 1990s and foreshadowing the global financial crisis, actually a year before that, we had a negative 2 to 10 year spread, and that also happened at the pandemic, and it's happening now. And so you can see each time, and that black line, which is to the left-hand scale, is where probability of recession peaks, and you can see back when you had negative 2 to 10-year yield spreads, that your probability spiked, and you had a high probability of recession within the next 24 months. And in fact, each of these times, back in 2001, 2008, and then briefly at the pandemic, each time we actually did hit recession when we had a negative spread in the yield curve. So again, it's a matter of when, not if. Here's a chart of various central banks on the left-hand side, and then the expectations of future rate increases for the Federal Reserve on the right side. So again, it's a global issue. You see expectations for more aggressive hikes, not only in the US, but also across the board. Now, if you look at the right-hand side in that orange bar, those represent expectations for the number of interest rate increases, not the magnitude, but the number of increases in 2022. You can actually see that number has come down. So it peaked in June, and we've actually seen that come down over the last 6 weeks or so. And that has to do with the fact that we're transitioning from this expectation of continued inflationary environment where the Fed is having to attack it pretty hard. And obviously we had 9.1% annualized inflation. So inflation's still out there, but the expectations, though, are shifting to a more to actually interest rate decreases in 2023, and you can see that in the black line. I mean, up until June, there was no consensus whatsoever that there would be any rate decreases in coming next year, but that number is beginning to spike up, and so we see the expectation actually coming off of perhaps 12 rate increases in 2022, that in 2023 we actually have 2 rate decreases. Again, going directly to this notion that the consensus is changing to prepare for a recession. Well, if we want to look at inflation pockets, there's a lot of things we can look at, but one thing which I thought was interesting: fertilizer prices. Natural gas is a key feedstock, if you will, for fertilizer manufacturing, but we know that Russia is a key supplier, and obviously there's an embargo going on there, so prices spiked, but they were already going up before the Ukrainian invasion. But it's interesting to note that fertilizer prices are back at their pre-war levels. It's a pretty interesting chart here. And then we also see used cars and truck prices going down after they spiked earlier this year. Number of consecutive daily declines in the average U.S. gasoline price. Now, I thought this was a pretty interesting chart, and it goes back quite a ways. And you can see that there are stretches of time where you get like 20 to 35 straight days of gasoline price declines, and most of us don't really even notice it at the pump when this happens, because it's so gradual and it's so non-tectonic when it happens. It might go down a penny here, a penny there, but we've actually had 25 straight days of gasoline price declines, which I think if you filled up lately, you certainly would have realized relative to just a month ago. Here's the owner's equivalent rent, which in the CPI, Consumer Price Index calculation, particularly at the core level, it's like 30% of the index, and so it does matter. And so when you think about CPI going up at a 9.1% rate, and even like 5.9% at the core, or 5.7 at the core, OER actually matters. And we know that rents overall lag prices by about 9 to 12 months, say. And so they've really perked up. Now, this isn't rents in the purest definition. It's defined a little bit differently. But it's a good proxy, and you can see where that number has really moved up higher to 5.5%. Here's something I mentioned a few slides ago, the food and energy basket. Food and energy in that orange on the left-hand chart, you can see where that's moving higher. You can see core CPI against all items there. You can see the impact of food on the overall CPI. You can see that it's moving at a faster rate. And then as we just saw, owner's equivalent rent moving higher too. So these are really the two bugaboos right now on inflation. Now, that's not to say that energy isn't important, but it is clearly food that's driving the wagon right now. And here's a chart from B of A research showing prior business cycle peaks and where inflation was at that point in time, and then it shows the inflation number 2 years later. So you can see in all cases that you have inflation moving down. Now, obviously, February of 2020 was a different story altogether because we have the shutdown, and obviously we had higher inflation a year henceforth, but that was the exception to the rule. That generally speaking, you saw inflation down 2 years later. And in that red bar, it shows you where we are today at really closer to 9%. And obviously the last reading was 9.1%. So that's not as high as where we were in 80 and 81, but the consensus is right now that 2 years later, that inflation number is still going to be high. And I think this is the big if right now and the big question mark, because if we do have a slowdown and we do know money supply is going lower, and if that's the case, inflation comes down, where does inflation end? And right now the range of potential outcomes looking out into 2024 is wide enough you could drive a truck through it. You do have people that feel in this case where you're going to have higher inflation 2 years henceforth, but you do have folks that expect it to get closer to, call it 2.5% to 3% 2 years henceforth because of recession. Here's a chart from FS Investments in Philadelphia. Do a really good job on the economic analysis front. And this is, as they've sliced and diced it, basically the sticky price contribution to the consumer price index. You see in that black line, that represents the overall CPI. And then underneath that, they parcel out what they feel are, the sticky elements. And in this case, I'll call like wages and rents as being more sticky, and obviously the food and energy being a little bit more volatile, but it just represents here that there's an increasing contribution, not in percentage terms necessarily, but in aggregate terms of items that are going to be a little bit more sticky and maybe less flexible to come down. So as we reflect on the chart that we just looked at, which had, kind of showed a range of outcomes and perhaps even like an expectation that we're going to have higher inflation 2 years out, not that we have now, but just at a higher level that we've seen over a long-term trend line. This chart would tend to suggest that you have stickier elements that are not as apt to come down as quickly. Now we'll talk about housing for just a second. Home buyer mortgage payments are up 43% year over year. You can see where that in that red line, that's pretty stout. This is data from Redfin. Both of these are from Redfin actually. And then we've shown this chart before a couple weeks ago that we've had more price drops here in the 4-week rolling average up through, I believe, beginning of this month. So, I mean, that number is probably even a little bit worse. You can see the inherent seasonality of price actions within the residential housing sector, but you can see that tremendous jump at the end. So I think this is a sign of, the fears of recession, kind of the moderation of expectations on the part of not only home sellers, but also home buyers. And again, mortgage payments, that has some sticker shock to it. Here's the relative cost of renting versus owning, and you can see the monthly rent is up in the blue bar. And so when you think about the the average cost of home ownership, and this goes back to some degree about the owner's equivalent rent, the OER component of the CPI, and you can see where monthly mortgage payments based on a 20% down payment level, on balance for the same size house, so on and so forth, that gap is not nearly as wide as it used to be. In fact, it's narrowing quite rapidly with the rise in interest rates, and that's driving 30-year fixed mortgages up much higher than where they were. And we've seen a tremendous, and not, I won't call it unprecedented, but we've seen a pretty tremendous increase in mortgage rates in just literally the last 3 to 5 months. Well, here's crude oil futures. We talked about gasoline prices going down, and so we're actually down, say, really close to the levels that we were, if not slightly below the levels that we saw on crude oil just before the Ukrainian conflict broke out. And this is actually a pretty dramatic chart. So we've seen quite a few commodities come down, and not the least of which is crude oil. This is very interesting from B of A, from their quant team. They showed, we've got a chart in here on the US dollar, which has been exceptionally strong. In fact, the euro is at a 20-year low relative to the dollar. And obviously, when you have a strong dollar, it makes your exports much more expensive. And so in this case, what B of A found is that foreign exchange, basically the strong dollar, was a 2 percentage point headwind in sales, which is the biggest headwind that we've seen since 2015. And so, if you get into the data and you assume that sales are going to roll over, you're heading towards a recession, you've got a strong dollar, that's just going to hurt you actually even a little bit more. Here's valuation versus earnings, and I thought this was great research by Fidelity Investments, and what they show here is that in the I'll call it the yellow bars, of course you've got the index itself in the black up above, but down below you see in the yellow bars you have earnings growth, and then in the kind of the lightly shaded blue bars you have price to earnings changes. And so we know that the PE ratio has gone down dramatically in the last year. In fact, it's down 35%. That's good, right? So valuations in the market have definitely come in, which is what we want to see. But it's coming at the same time that we're seeing stalls in earnings growth. And again, we're heading towards a slower growth environment, so you'd expect that. But you can see how these things kind of oscillate. And so, when you have market downturns and you have, the risk of recession, you obviously see, and you see higher interest rates, you have PE ratios come down. But, in most cases, you have that trough and PE ratio drops. And then you have earnings that drop, which actually make that PE ratio go back up again, because that's the E, that's the denominator. And so we're at a really interesting inflection point coming off the pandemic, the post-pandemic era, I'll say. And here's a chart from BCA I thought was interesting, that unlike in past cycles, excuse me, stocks have peaked earlier this year, well before earnings rolled over. So, what's interesting in the last slide, we do see earnings beginning to roll over, but we saw the drop in stocks happen a lot faster this time to when earnings drop than we've seen in prior cycles, which are depicted here. S&P 500 revenues typically decline in a recession. So we haven't seen that. We talk about earnings and the leading economic indicators, as we discussed earlier, typically point to negative earnings growth. So, obviously in a recession, you've got contraction. So you ideally have, revenue declines as well as negative earnings growth. You can see that the time series here as you overlay S&P 500 revenue with nominal GDP, that there's a pretty good relationship there. So with GDP rolling over, you'd expect revenues to go down. Now, revenue estimates are still positive. Analysts still have, a fairly reasonable mid-single-digit expectation for revenues looking out for the balance of this year, and they also have a reasonable mid-single-digit estimate for earnings. Now, the big question is whether that changes, and we're going to know a lot. We're on the eve of earnings right now. I'm not sure that the early foreshadowing has been relatively positive. It certainly hasn't been overwhelmingly positive like it has been, but we're going to learn a lot over the next several weeks. Here's the S&P 500 in blue plotted against the forward 12-month operating margin. We do see operating margins begin to stall out here, but they're really still near record levels. Here's the rolling 5-year correlation year to year in changes in corporate profits and prices. So there's a reasonable relationship. It's actually strengthened in recent years where there's about a 0.6 correlation between the change in corporate profits and the S&P 500 price. What that means is it's not a foregone conclusion when you have corporate profits drop that you're going to see a corresponding drop in the S&P 500, but there's a reasonable chance you will. Here's ISM new orders, and we know the ISM is down. That's the Institute for Supply Management, and that is on the, I believe, the manufacturing side. And so, as I said, we're heading likely towards a manufacturing recession as ISM new orders drop below 50, which represents contraction. You typically see EPS contraction. That's not a big surprise. Down below, you see the dot plot and you see the line of best fit. And so there's a reasonably strong relationship there. It's not perfect, but there's a reasonably strong relationship there. So again, where I think it's reasonable to expect that you're going to have some contraction and certainly some slowing of growth in sales and earnings amongst the S&P 500. Now, on the flip side, one thing to consider that we have not, where we've not been before, a place that we've not been really before, is that corporate balance sheets are in really strong shape. Even though corporate debt to GDP has moved higher, obviously some companies took on more debt during the pandemic to build more seed corn, more operating liquidity buffers and things like that. But debt service ratio has gone down. So corporate balance sheets are much, much healthier than we've ever seen, or I shouldn't say that we've seen in the last two major disruptive cycles where we've had recessions. Here's a quick look at some of the cash alternatives, if you will, and fixed income items. So you've got cash, which has outperformed gold, tips, bonds. You see here the magnitude of this. The 30-year U.S. Treasury down 30%. This is amazing data right there. And on the right-hand side, I think it's something that we can all look forward to as we normalize ourselves. We get through what may turn out to be what I hope is a shallow recession where we can reset the bar. It'll get us to a short-term interest rate environment that's a lot more conducive for savers. We've had an environment that's been exceptionally tough for savers where money market rates have been near zero. This chart on the right from B of A tends to suggest that we're going to have higher money market rates in the future. Change in two-year Treasury yields. I found this particularly interesting because we talk a lot about the volatility on the equity side. This is a chart that highlights the fact that this year we've seen an amazing amount of volatility on the fixed income side, and particularly here the short-term rates, the two-year Treasury. Here's on the left-hand side the U.S. dollar index, which, as I mentioned, exceptionally strong. And one reason for that is on the right-hand side, which is a one-year Treasury rate. And again, I just showed you the chart where the two-year Treasury has exhibited tremendous volatility. And if you look at this one-year rate, I mean, we've been talking about the prospect of having a 3% 10-year yield for a long time. Well, now we got 3% yields in the one-year Treasury, and we haven't seen that since 2007. And these higher short-term interest rates are driving the dollar higher because we don't have the same level of commitment to raising rates amongst other central banks that we do here in the U.S. Cash flow statement for oil companies. Now, we've talked a lot about oil, and we talk about, even the rig count's up 55 to 60% year over year, call it. We still have a lack of enthusiasm over drilling. It's just been uncanny that we've seen such dramatic fiscal discipline. We've had much more interest on the part of energy companies, upstream and downstream, to distribute money back to shareholders. You see shareholder distributions on the bottom in the green spiking up fourth quarter, first quarter, really unusual in this environment. Cash flow, we see cash from operations exceptionally high, but we see capital expenditures not keeping pace. In other words, we don't see a lot of the domestic energy companies committing capital at this point, even though prices are still relatively high. Well, and this is a chart that I thought I would end on here. I thought it was very interesting going back to the 1970s and looking at, and we basically had, in a relatively short span, we had 4 recessions. And you can see each time here you had inflation moving higher. You've had interest rates moving higher, and then when you have a recession, actually, both of those go down. But, this is something that plagued the Fed for many years. And obviously in '73, you had the OPEC embargo. And then you see how in each successive peak and interest rate and inflation was higher than last. And when we talk about this whole era when Paul Volcker came in, inflation was amazingly high. You can see here, like, almost 15% inflation. And that's when I think the Fed finally decided enough was enough, and Paul Volcker punched interest rates much, much higher to kill off and choke off inflation, which honestly has been much lower overall ever since, up until recently. Well, that's all we've got this week. I hope you've enjoyed the chart pack. We'd love to hear from you if you have any questions. Otherwise, have a wonderful week, and we'll talk to you again soon. Bye.